Welcome to the Personal Finance Podcast for Doctors. This podcast aims to simplify all aspects of personal finance and helps you make smart and informed choices about money so that you can live happier and stress-free lives. Today's episode is brought to you by Chanda, who is a financial coach and vice president with the doctor practice at MFA, the only company in India having a dedicated practice for doctors.
Hi everyone, welcome back. Yesterday I was in a review with my client, a very well-known doctor, very experienced. He's about 61 years of age, just completed 60 last year. He's made a significant portfolio with very systematic investing, goal-based approach, and it was wonderful chatting to him. But we started talking about how the markets are moving, what he should do, what he should not do, considering the fact that he's looking at buying a new house for himself, which is going to cost him upwards of 10 CR. His daughter is going to get married next year, etc., etc. But what was interesting was the thought in his head that whatever the Sensex is doing or the Nifty is doing, how is my portfolio performing as I compare to that? So we just tracked. I just came back home and I started tracking what was the movement of the Sensex. Now, do any of us even remember when did Sensex hit 50,000? No, today we are talking about 75, 80, crash or a big jump coming in the next 1 or 2 years. But we don't remember when Sensex hit 50,000, which was a big thing back then. Or we don't remember when we hit 60 or 70 for that matter. Let me tell you. We hit 50,000 first in Feb 2021. In September 2021, we hit 60,000. Then we took about a little less than 2 years, December 2023, to hit 70,000. So we started our new year, 1st Jan 2024, with 72,000. April, we went to 74,000. Then again in June, we fell back to 72,000. So basically, the 6 months were wiped out. We went back to 72,000. Very next day on 6th June, we were back to 74,000. And today, in July, August, we are at 80 and 82,000. Right? So the question here, when the person asks, what's happening to my portfolio? Should I do something to be prepared or take benefit of this rise and fall? Or should I just passively wait? How will that impact me? Will I be able to capitalize on the opportunities that market ups and downs create? We get so caught up in what to do, what not to do, that we forget to check on the root question. Why? Why do I need to do what I think I should or should not do? We lose sight of our portfolio in the race to do something. Let me explain. Your portfolio is not the Sensex. It is not the Nifty 50. It is not a mirror of the index. See, most of these Nifty 50, Sensex, Nasdaq, Standard & Poor 500, whatever it is, these are weighted averages of the price of a selected group of stocks. These indices, they provide a broad measure, a very broad measure of market performance, but does not reflect your portfolio performance in comparison to it. See, actively managed funds are based on expertise of the fund managers who strategically choose investments based on a variety of factors. Could be economic conditions, company fundamentals, market trends. As a result, the performance of these funds can significantly differ from that of the index. Now let's take Nifty 50 for example. It's a large cap index. It is dominated by few heavyweights like Reliance Industries, HDFC Bank, TCS. If these companies perform well or poorly, or there is some news regarding to that sector, they can have outsized impact on the index. However, your portfolio might be more diversified or focused on different sectors. So the performance of your portfolio can be significantly different from the index. There are many technical concepts to understand, but I know I will not digress from the essence of this podcast. So let's understand the fact here that your portfolio is not the index. Sectoral rotation is one of the critical factors that you need to understand. Now, I'm getting a little technical, but still, this is very important to understand this concept. Now, different sectors of the economy perform well at different times due to various factors. It could be interest rates, economic growth, technological advancements, regulatory changes. For instance, there can be a period when banking stocks outperform, while there might be times where IT companies can become the new market leaders. So there is constant rotation of market leaders, which means that even if the index remains flat, different sectors and therefore different parts of your portfolio could perform differently. So winners in the markets keep changing. Today's top performing sector might be tomorrow's laggard. So this constant rotation can lead to significant differences between the index and your portfolio's performance, depending upon the exposure, the timing of the fund manager's decisions, etc. The key point here is the stock market goes up because some companies and sectors will lead the market higher. Then they fall. This does not mean that the stock market falls. Instead, some other companies or sectors can take the stock market even higher. So the core point to understand is that your portfolio and your portfolio's performance is unique. It is crucial to remember that your portfolio's performance is unique to your strategy, the specific stocks, sectors, assets you've invested in. Just because index is at a certain level doesn't mean your portfolio will be at that same level. And there are several reasons for this, like I said. One is diversification. So the few reasons, remember, for the difference in your performance of your portfolio from the index is one, diversification, because your portfolio is diversified across various sectors, not just the top 50 companies. They are diversified across geographies, across asset classes. So it's definitely possible that being concentrated on certain sectors, this portfolio will perform differently. Now, within the same sector also, let's say defense sector, different companies will perform differently. So your portfolio may hold stocks of companies that have better growth prospects compared to others which are in the index. The other important point is dividends and income streams, right? So the index reflects price movements, but it does not account for dividends and other income streams that your portfolio might generate. Dividend-paying stocks or interest-bearing bonds can contribute to your overall returns, which is independent of the index movements. Now, another important point is rebalancing. The index may remain static, but your portfolio might still benefit from strategic rebalancing. This means selling when the markets are high, in your portfolio certain sectors are high, and then you buy low in a disciplined manner in probably some other sector, keeping your portfolio in mind. Yes, there are tax consequences for doing so, and therefore you have to be very thoughtful about rebalancing. In all this, our compass really is our financial goals. The performance of my portfolio may be influenced by many factors, multitude, many of which are independent of the index. Remember, the index is a good, useful benchmark, but not a definitive measure of your portfolio's success. Understanding the reason behind the difference between the portfolio and the index will help you make informed decisions, set realistic expectations, and it will not make you question why you are changing certain things in your portfolio or why you're not changing certain things in your portfolio. Remember, the winners in the market keep rotating. Today it might be IT, next time it might be banks, next week it might be infrastructure, whatever. Time and again, things will keep changing. The key is to stay patient, behave well, and focus on your long-term financial goals. I hope this helps. Thank you for listening in.
You were listening to the Personal Finance Podcast for Doctors with Chanda Verma. If you find this podcast relevant and interesting, do share it with other doctors as well. It will be great if you leave a review, share, like and subscribe. You could also let us know if there is any specific topic that you would like us to cover. For any queries or help, you can get in touch with MFA's Doctor Practice Team at 892-800-6140.